you're looking at it as a business. Now you've got, anything can happen in markets. I mean, anything can happen in markets, and that's why I say don't ever.
Warren Buffett, one of the world's richest people, just invested a mind-blowing $6.7 billion in a new company. Why is this so huge? Buffett is famous for being super careful with his money. So, what made him take this big leap? One June morning, news broke about Warren Buffett's surprising new investment, and financial enthusiasts worldwide were buzzing with excitement. For a really long time, reports have been swirling that an unbelievable financial backer, Warren Buffett, had been concealing a mystery stock buy or another expansion to his portfolio that he had intentionally left hidden, known for his skillful approach to value investing. Buffett had obtained special permission from the SEC to acquire shares of a company without first making it public. How could the SEC concede such a special case for its revelation rule? Indeed, it's a peculiarity known as the Buffett impact. Investors rushed to imitate the Oracle of Omaha whenever Buffett's company, Berkshire Hathaway, announced a new stock purchase.
On all kinds of interesting things when I was 50 or when I was 20 or 21, and I don't imagine there's anybody here that knows about the Green Bay and Western Railroad Company, but there were hundreds and hundreds of railroad companies, and I like to read about every one of them.
The SEC enabled Buffett to establish his position prior to an inevitable price surge by allowing him to first accumulate shares privately. This was not the first occasion when an exception of this kind was granted. Back in 2020, Buffett had been given a comparative relief for the acquisition of Verizon and Chevron stock. Be that as it may, this most recent mystery holding was especially strange. Even only weeks before Berkshire's yearly gathering in May, monetary media sources like CNBC were quick to grill Buffett about it. However, the investing legend did not comment at all during the meeting. At long last, the expectation arrived at the breaking point when Berkshire's Q1 2023 13F recording was delivered in mid-May, rattling off the organization's quarter-end property. What is Buffett's enigmatic new stakes? Berkshire Hathaway's equity holding now total more than $6.7 billion, making them the 9th largest position. So, how could the 92-year-old prophet take such a distinct fascination with a protection firm? An interview might wonder why Warren Buffett found a seemingly traditional and mundane insurance industry so appealing when he decided to invest in Chubb. The likely response from Buffett would be a mischievous smile. Indeed, Buffett was absolutely correct that insurance isn't the flashiest of businesses. However, that was precisely the type of routine, unassuming operation that he tended to favor. After all, he started his career in insurance over 60 years ago with GEICO. In fact, Buffett's very first investment after taking over a struggling textile firm called Berkshire Hathaway was in 2 insurance companies, National Indemnity and GEICO. For decades, insurance had formed the core economic engine driving Berkshire's success. As Buffett often explained, the real appeal lay in the concept of float. The premium insurers collect upfront and can invest in their own benefit until claims eventually need to be paid out. Buffett told insurance companies make money by holding onto people's money for a while. You might say this is almost like legally printing money, as long as the insurance company is careful about which policy it approves and keeps claims under control. A lot of those premiums become free money for the company to invest however they want. So, according to Buffett's viewpoint, a very much run, moderately guaranteed protection business fundamentally loses ceaseless minimal expense money to be reinvested into other worth plays. It's a significant intensifying motor, and one the financial planning expert knows basically everything there is to know about from over 50 years in the business. With its extensive global insurance offerings and excellent underwriting discipline, Chubb must have appeared to be an ideal match. However, the investment rationale extends beyond insurance's very nature. As Buffett is popular for teaching, it's basic for any obtaining to be inside his company's circle of capability as such, a business they really comprehend. He has spent decades studying and operating major insurers like GEICO and General Ray, so he is very familiar with them. Chubb's sheer size and scale likely played a significant role. At more than $100 billion in market cap, it gets the bar free from being adequately enormous to physically affect Berkshire's $250,000 market esteem. Buffett could explain that with Berkshire Hathaway's tremendous size nowadays, they really had to aim for the biggest companies and focus on the largest, most prominent ones in their industry. Though some smaller companies may be attractive investments, he said they wouldn't be impactful enough for a company of Berkshire's massive scale. Therefore, Chubb passed the size and competency test. Yet, shouldn't something be said about execution and valuation? All here as well, the protection titan appears to really take a look at Buffett's cases. Pulling up Chubb's financials, one can't resist the urge to be intrigued by the astoundingly consistent development, no matter how you look at it. Over the past decade, revenues have increased by more than 11% annually. What is the operating income? Up consistently throughout each year. Total compensation has developed at almost 14% each year. Quick forward to the latest Q1 2023 period, and you'll find twofold digit year-over-year expansions and expenses composed, guaranteeing pay, and that's just the beginning. Buffett could say that Chubb is exactly the kind of steady, growing company that Berkshire wants to invest in. He might explain that unlike flashy tech firms, Chubb doesn't just focus on growing quickly at all costs. Instead, Buffett could state that Chubb builds value in a reliable way over time by running his business intelligently and managing risk carefully. The consistency doesn't stop at the pay proclamation by the same token. A look at Chubb's fortress, like balance sheets, reveals investment totaling over $114 billion and a massive reserve fund of $61 billion set aside to cover potential claims in the future. Buffett has long emphasized the significance of maintaining sufficient cash reserve to withstand any anticipated rise in policy payouts. It appears that Chubb has covered that base numerous times. However, price versus value is always the focus of investing. What was Chubb's valuation multiple at the time Buffett took over in late 2022 and early 2023? Despite the strong fundamentals, was it at nosebleed level? Not by any stretch of imagination, it appears. Based on today's share price, Chubb was actually trading at a discount to its average price to earning ratio of 15 over the past decade. It clocked in at a mouth-watering 9% range, a nice healthy level compared to most companies, and the prices Berkshire reportedly forked over as it builds this massive multi-billion-dollar position. Quite attractive as well, ranging from $200 to $330 per bit. For the value-conscious Buffett, that suggests that he was paying a very fair, if not downright discounted price to scoop up shares of his high-quality cash gusher. Obviously, the incredible financial backer would probably remind us with modest that he's not dependable. Buffett might humbly warn that he has certainly made many mistakes over the past decades, and will undoubtedly make more mistakes in the future. Time will tell whether Chubb was a good investment decision or one he will regret down the road. He can only try his best to stick to his principle of investing in great businesses at fair prices within his areas of expertise, with plenty of room for long-term growth. He may then acknowledge with his trademark humility one of Berkshire's other major moves this quarter, reducing their stake in tech giant Apple by 13%. He knows it is unconventional for value investors like himself to own shares in a company that many consider a growth stock. But he has always said it's important to keep an open mind and look at a business through underlying economics, not just surface labels. He could explain that with Apple continuing to trade at very high valuation levels while facing increasing competition and geopolitical risk, they thought it was wise to lock in some profits now. Especially with the possibility of higher corporate tax rates looming, it made sense to realize some gains ahead of time at the current 21% tax rate. However, Berkshire still hold a large position in Apple and remain confident in the company's future as long as they keep executing well. A significant expansion in company's exchange position, including Sirius XM satellite radio and the Freedom Media following stock. He might explain that while these types of special situation investments aren't Berkshire's main gig, they can make sense when there's a clear mispricing in the market ahead of a corporate event like a merger. In other terms, Buffett could say that if one thing is trading for less than it's truly worth because of an upcoming transaction, pay to swoop in and take advantage of that disconnect while it exists. That's just what they were doing by boosting their stakes in this case. With Freedom Media owning a supermajority of Sirius XM shares while its own tracking stock paradoxically traded at a specular discount, Buffett would likely say it's made financial sense to allocate some capital to profit from that spread as the two companies move to combine into one entity. That's a wrap. Warren Buffett's $6.7 billion bet is huge news. What do you think about his investment? Share your thoughts in the comments. If you enjoyed this video, give it a like and don't forget to subscribe for more amazing stories.